sectors and institutions can competitively and sustainably bridge these gaps and make available the much-needed financing required to support recovery and growth of the above two sectors without compromising resilience and growth of the banking sector itself. Funding goes hand in hand with expansion of markets, which is where the cash flows come from. Support towards access to and opening of markets, especially around the region, as well as attracting of more visitors as we build capacity, will therefore be very critical anchor pins of a sustainable funding strategy. We accordingly need to, amongst others, review fiscal policies that ascertain inflow of private capital, be it debt or equity. We need fast-track legislation that enables the banking and financial sector to expand and deepen. We also need to ensure that we cultivate good borrowing and a repayment culture to attract more finance providers, and also take into account ESG matters that are now central to the flow and sustainability of any business. For this to happen, the economy relies on policymakers, legislators, private sector players, and indeed all of us. Ladies and gentlemen, I'd like to use this opportunity to intimate to government and the private sector players, particularly the manufacturers who are today's dedicated audience, that the banking sector are your key partners, and beyond the custodial, tax collection, payment, facilitation, and extension of credit roles we play, including to government through investment in government securities, as well as provision of infrastructure financing, support through trade services. We are, and I would like to really emphasize this, we are currently working on a specially structured and customized regional export credit facility to the tune of Uganda shillings 1 trillion to support our manufacturers involved in regional export. We plan to have this export credit facility launched later this year by His Excellency, the President of Uganda. Uganda not only has comparative advantage in agriculture and natural resources, but is equally endowed with the critical factors of production like land, skilled labor, and electricity. So the objective here is to really plug the existing gaps, facilitate production, provide funding support to the catalytic and powerful entrepreneurial ecosystem through fostering, amongst others, technology innovation for enhanced value addition to drive export growth and fully harness the attendant trickle-down benefits. Ladies and gentlemen, today we will hear from various conference resource persons who have graced our conference. In a special way, allow me to welcome our keynote speaker, who will be introduced in more detail. Mr. Fofak and Mr. Louise, we thank you both for accepting to come and share with us your insights on the theme of this conference. I'd like to convey our sincere gratitude to the Deputy Governor and his entire team at Bank of Uganda for the continued stewardship of the sector, particularly in these challenging and evolving times. Special recognition goes to government through the Ministries of Trade and Industry, Tourism and Antiquities, the Ministry of Finance, and all its various agencies for the important role they play in this journey. To you all, our sponsors and partners, including MasterCard and ABI Finance, I say thank you very much. Asante sana. I would also like to thank the panelists, writers, all stakeholders and participants who have logged on and are participating online, for coming to share your knowledge, insights, experiences, above all, hope. And importantly, I'd like to thank the UBS Secretariat under the stewardship of the ED, Wilbro Dewar, and your team. Thank you for putting this together. I wish to conclude by saying that as a sector, we're fully cognizant of the delicate balance between facilitating growth and at the same time remaining resilient as a sector, especially in these challenging times. Critical to this resilience is the demonstration of the role that we play in embedding sustainability in every aspect of our mandate. Looking ahead, sustainability will be an even more integral part of not only what we offer for our borrowers as they access capital, but crucially, a basis for us to challenge ourselves on how to fully and sustainably unleash the sector's full potential for supporting national and economic social transformation of Uganda. We therefore count on your continued support in bringing alive all the recommendations that will arise from this conference as we foster economic recovery. I thank you all.
Right, so I might have neglected to say something extremely important. I'm going to ask Sarah to stand here because it's a very important note. Did you know that this is the first female chair of UBA? I mean, put her extensive years of experience and everything aside, congratulations. Thank you for getting the ceiling and just throwing it out. In a few minutes, I'll be calling you back to give us the honor of calling our permanent secretary, but I'll let you sit for a bit. A big thank you to our sponsors. Yes, by the way. You can't talk inclusion and not throw a round of applause for such things. Ladies and gentlemen, our sponsors, we want to thank Ragzio, the data setter company, who've actually made it possible for us to be here. A big thank you to Finca. We've got BPC, Afri-Exim Bank, MasterCard, who will actually be having a couple of conversations today. We'll also like to thank, of course, our co-host, BOU. We'd like to take eyes to the screen wherever you can look for something.
Economies across the world plunged into deep contractions in 2020, no thanks to COVID-19. There wasn't one industry unaffected. Manufacturing, and most especially tourism, were no exception. For Uganda, the disruption to manufacturing caused severe operational, social, and financial consequences. For tourism, tourist arrivals and forex earnings dropped greatly. But what can key primary growth sectors of an entire country do when they're shaken up by a health crisis? They adapt, they survive, revive, and they must dare to thrive. But to thrive, sectors require timely and tailored financial support to anchor their recovery and growth. And there's no sector better placed to take center stage and steer their recovery than the banking sector. Now is the time for us to redefine our role as the backbone of our nation's economic recovery. This year, we discuss how best we can begin bridging financial gaps in the manufacturing, tourism, and agribusiness sectors to catalyze economic recovery and growth post-2021. Ladies and gentlemen, welcome to the 5th Annual Bankers Conference 2022.
Just remind you that we are live online and on NTV Uganda. We'll also have a hashtag. It's actually BankingConf22 conference, but short of it. So it's BankingConf22. We're on Twitter and all the other platforms. Allow me to now welcome the chairman for the Uganda Manufacturers Association to give us a few words. Mr. Deo Kayemba, please join us. Welcome, therefore.
Good morning. First off, just to say Mr. Deo Kayemba looks different from me. My name is Daniel Berunji. I'm the Executive Director of the Uganda Manufacturers Association. and I'm very glad to be here. The chairman, Uganda Bankers Association, the permanent secretaries of the Ministry of Trade, Industry and Cooperative, our mother ministry, and the Ministry of Tourism, Wildlife and Antiquities, the Deputy Governor, Bank of Uganda, distinguished guests, ladies and gentlemen. First off, allow me to congratulate the Uganda Bankers Association on holding yet another Bankers Conference, and to hold it in a period where we are speaking about recovery, and to theme it appropriately is also something worth celebrating. As manufacturers, we certainly have a long relationship with the banking sector. This relationship has birthed a number of the big names that we see in the economy today. And for that, the manufacturing community is very grateful to the Bankers Association and the members therefrom for the support that we've gotten thus far. Of course, talking about that, we can't also go ahead without speaking about the discussions we've had in the period post-COVID around recovery support, around deferral of payments, and for these, I believe that you deserve a hand clap for coming out to support the manufacturing sector through the last 2.5 years that were pretty much unexpected on all sides. Of course, we are also cognizant of the fact that the sector is understanding the needs of the manufacturers. Madam Chairperson, the discussion on the export credit facility is a particularly welcome discussion, because this is a discussion we've been having for quite a while. We are definitely grateful that this conversation has taken fruit and that we are now at the cusp of launching something that we believe as manufacturers is a game changer in terms of access to the region, in terms of access to the African Continental Free Trade Area. Ladies and gentlemen, while preparing for this, we thought about 3 areas that we thought would highlight today for the bankers to appreciate in as far as manufacturing is concerned. And these 3 areas, in our mind, are critical in enabling recovery and, with reference to the theme, in enabling the addressing of the gaps that we see existing in terms of financing for manufacturing. The first area would be the area of affordable and long-term financing. And I believe that it is a conversation that we've had for quite a while. We can see that you're beginning to move to listen to this. And it goes without saying, really, that as we speak NDP 3, as we speak to the fact that we are moving to import replacement as a nation, we then get into an area where we have to invest in things like iron ore processing. Now, for iron ore processing, everyone will tell you that getting a commercial bank loan with a tenor of 3 to 5 years is laughable in that case, because there is no way you're going to set up and start effectively processing your iron ore in 3 years. You need 10 years as a bare minimum to even start thinking of sustainability of this. If you talk about textiles, if you're putting up a spinning mill, a textile mill, a fully integrated textile mill, these are the periods we are looking at. And so I hope that today we can, through the conversations we are going to have, also appreciate where the challenges are to the reduction in pricing of these term sheets, but as well to the tenors that are usually available. The argument I've often heard said, and I'm glad the Deputy Governor is here, has been around the fact that with the appetite of government where it is, it becomes easier for me as a commercial bank to lend to government through treasury bills, because they are reliable, they are available, and I can sit back and wait. Little wonder, therefore, that I'm sure that all the CEOs in here are smiling, because post-declaration of results, I've read the results, and you people are doing well. You should clap for yourself. It's good times to be a banker. But as we speak to that, I think from our end, the conversation is, how do we ensure that it's sustainable, that these bonuses are sustainable on your end? And in our mind, sustainability of these bonuses lies heavily in being able to stimulate the sectors that can deliver to you sustainable profits. And we believe that these are in the areas of sustainable manufacturing, long-term manufacturing, discussions on iron ore, textile, and other deep value chains, because these are the ones that can deliver what we are looking for. That's number one. Number two would be the issue of pipeline development. I've had several discussions with several bankers, and our discussions have always been to say that we have to get our hands dirty as bankers and get involved in the process of preparing the people who are coming to us to borrow. I'm glad that members of the Bankers Association have taken this call up. We've seen several bankers and banking agencies setting up incubation centers, SME development hubs, and we congratulate you and applaud you for that. However, like Oliver Twist, we want more. We want you to walk along with us every step of the way as we develop the capacity to grow our businesses. Because from where we sit, it's a win-win situation. Once the SME grows, you as a banker grows. For the names that we see today in the sector, the roofings of this world, the steel and tubes of this world, what did these start out as? They started out as SMEs that were struggling to make ends meet. But today, I'm certain each of the CEOs here would quickly run to attend a meeting with them if they promise to switch their accounts to you. And we are saying, work with us to support these SMEs to grow so that you can then reap the benefit as we go along. Third would be the area of export development. And Madam Chair, I think one is to, like I already said, say thank you that the export credit facility is finally coming to fruition. Ours is to say that there is also more that can be done in terms of support to export development. We are in a situation where we have a captive market in the DRC, with several of the products that we produce here able to competitively access that market. The average challenge still remains that the people trying to take these products there cannot access affordable credit to take it there. But relatedly, you have the possibility of leveraging your international networks to support in the areas of, for example, access to machinery for small-scale manufacturing. If you have a link bank in China, why should a manufacturer in Uganda have to fly to China to check on the viability of a supplier? Can this be something that is offered within the banking circles? Because then it's a case of you leveraging your international footprint to be able to access some of these facilities. Relatedly, we also need more of you to move into some of the markets that we are going into. We're talking DRC, but what is the footprint of banking, especially Ugandan banking in the DRC? It's not that big, and I think there's scope for entry there and scope for support. On that note, I wish to also say that it's not all doom and gloom. I was told to be candid, and I've been candid, but I also wish to say that we are definitely grateful for the journey we've walked thus far with the Bankers Association. There's a lot that we've been able to achieve as a result of the support of each and every one of you in this room. And as the manufacturing sector, we salute you, we pledge to continue working with you, and we hope that we can come here next year and look at the results of the discussions from today and celebrate to say we've actually moved forward. Thank you very much, and I wish you fruitful deliberations.
Thank you so much, Daniel Birungi, the Executive Director of Uganda Manufacturers Association. Delighted to see you. I think we got a better bargain because you made lots of great notes. And what stands out there is that they want more. Gone are the times where a bank is just, will give you money, will fund your dreams. My dreams are bigger than that, and you have to understand that. You have to understand the value addition I need to bring to the markets. You also need to understand what he just said. You're not competing domestically, regionally, yes, but also globally. So how can a bank help me get everything from access, the networks he's talking about, help me add value to what I am doing? And these are the conversations to be had today. Allow me to welcome back the chairperson for the Uganda Bankers Association to help us then invite the permanent secretary in the Ministry of Trade, Industry and Cooperatives. Ms. Sarah, please.
Thank you, Flavia. It's my distinct honor and pleasure to invite the PSST
emphasis of the matter. MTIC is mandated to formulate and review and support policies, strategies, plans, programs all throughout government to ensure the expansion of diversification of trade, cooperatives, and environmentally sustainable industrialization. Many of you will understand that when I say environmentally sustainable industrialization. Appropriate technologies to develop and transfer and generate wealth across our country for us to properly become middle income status and beyond. For us, that is simply our constitutional mandate. As government, we cannot do much without private sector. And I'm so glad that you have critically themed this Bankers Association conference around bridging financing gaps in the manufacturing, tourism sectors to catalyze economic recovery. The tourism sector, as well as manufacturing, trade, and the cooperatives are the biggest GDP earners of the country because they account for about 28%. And, you know, if you add them all together, they are actually driving the economy fundamentally. But again, sadly, they are underfunded, and that is a fact. And here, I am here to speak facts. I'm not going to gloss over anything, and at least people know that I speak facts. So in terms of driving the programs of government under those very sectors, the financing is limited. And that is why it is very critical that we are here today for the private sector to help government push all these things forward. So for me, so I would like to thank Mr. Wilbrod and his entire team for choosing this very topic. And I'm going to leave you with just two major things. And the two major things that I would like to leave you, after you have scripted this very well, is one, actual financing in the manufacturing, the actual financing that is required. Those are then also financing gaps that can be bridged and the required financial inclusion of small to medium enterprises to catalyze economic recovery and growth post-2021 COVID for the financial institutions. But before I go into the two issues in depth, I would like to say we need to scale. We need to scale on everything that we do on those 2 points. Why do we need to scale? Because we will have so many symposiums on an annual basis. There will be very many conferences within Nairobi, Tanzania, Arusha. Everybody is talking about financial inclusion. We know everything. We know our problems. We know that there's expensive financing in the private sector. We know that. Uganda is the place where every document on development is written and these things are implemented in other countries. We are brilliant people. We write theses, we write consultancy papers, we write reports. But the lacking bit is the part of implementation. I do not want to go away from this conference without the assurance of the members in this room that we shall have outcomes from this 2-day symposium, which we shall leave you to deliberate, but at the same time, we shall have a report like a cabinet paper which we can take away as feedback from the private sector to government on how we can actually implement. And I'm hoping that there will be a team that is formed to go away and highlight the key issues, the key deliverables, so that every party and stakeholder included is included, and every responsible party is given their timelines and deliverables on exactly what we need to get out of this conference. Otherwise, we may not turn up next year. For me, I don't want to invest my time in conferences which do not deliver what we intend to do. But I know that there's a lot of money in this room. That's all I know, and that's why I came. So, actual financing gaps. Mr. Deo Kayemba has already mentioned. So the systematic presence of financial institutions and their smooth functioning is very critical for all these programs. And indeed, we are cognizant of their central contribution over the years for implementing government programs and all the financial systems that have been crafted to deliver on the same. Many of you have been singing this song of Parish Development Model, have been singing the song on NDP 3 Millennium Goals, have been singing the songs of sustainable development and all those things that go with it. But we also need the money to back it up. The good news is that we already have evidence that the banking sector is in there. But how they are in there is what really matters. So on the first thing, when I'm talking about financing gaps, let me just give Uganda status at the moment. So currently we have all the domestic investments that are happening. We have the Uganda Investments Authority, we have UDC, all these people are delivering, but really it is not sufficient. If you look at the percentages, they are not sufficient. So delivery on promised NDP 3 government goals is limited unless we have about minimum of the 16% GDP which is contributed by manufacturing alone. So if we can propel manufacturing in a way that helps us on the gaps where we are talking about import substitution and export promotion, just think about the funding gap being geared towards just those two things. And I wanted to give just one example that happened in Uganda 5 years ago and then left us and went to Tanzania. I have given that example to Mr. Wilbrod already, but I'm going to share it with you for the benefit. When Tanzania realized that they need food security, they went out and just decided to do one item on food security. They didn't do much. They just decided we shall do rice. So they organized themselves in such a way that they can look for resources to do rice as food security in Africa. But the people who went to Tanzania to do rice started here in Uganda. They came in from Norway and other European countries. It was a team of people from European Union and private sector. They docked in one of our hotels here at Golf Course and started engaging government agencies, MDAs, and all the people who are involved in production. So as it all happens, they promised them that they would take them to State House. For 5 years, that did not happen. Because you cannot invest in this country if you haven't got the blessings of the top office. So they went round in circles until they were frustrated to the extent that they left. Now when they left, they actually found the banking sector in Tanzania ready. They found the banking sector ready to mobilize resources to implement exactly what failed to be implemented in Uganda. And why they had chosen Uganda is because they were told we have one of the most fertile soils in Africa. So they left, but they were willing to even put in fertilizer, even if the soil was bad. But what happened is that they were led by Exim Bank, together with all the other banks. They put resources together and they went deep into the value chain of rice. And today, they are the biggest producers of rice in Africa. Madagascar follows, and they are feeding South Africa, they are feeding the whole continent on rice. And that is why you hear the story about rice coming in from Tanzania to beat the local production of rice in Uganda. They have gone into scale as well. So you as bankers can also choose some of the big items. If you see URA has about 15 items for which are candidate for import substitution. One of them is coffee. And the statistics can come in later. But as you know, Uganda left the International Coffee Organization. So we have an opportunity to sell our own coffee and go big on coffee because we know that it will fetch very high prices in Europe. We are not coffee drinkers, we are coffee producers traditionally, and it's one of our biggest cash crops. But we have not invested in that value chain that deep. So if we choose one of those, I can assure you, we have got orders from China, which I don't even want to talk about because I know that we cannot fulfill the market of China. We are talking about 73 billion people, and they have placed orders for coffee, they have placed orders for sim-sim, they have placed orders for shea butter, and they have placed orders for maize. I have not responded because I don't have the scale and quality of production to feed the Chinese market. But I know that if the bankers in Uganda are organized, and by the way, there is a lot of room for everybody. Right now is the best opportunity for bankers to come together and tap into these markets because there is money to be made everywhere. There is no time for competition. Competition is really secondary right now because there's a bigger goal to get on the bigger markets. People talk about DRC. DRC market is too big. When they started placing orders here for fish, we are looking for fish. We can't even give them fish. They want fertilizers. We went, we did the negotiations with them. We signed all the MOUs and everything in DRC. Congratulations to Equity Bank. They have their footprint in there first. I think other banks will follow and provide services. But the most important thing is provide and tailor products that can actually service these sectors effectively. Right now, we have very expensive financing on the market, which is insufficient for driving production. So for me, if we go away and I take you back to the production, if we can say the top 10 or 15 products and services that we are importing and we want to do import substitution and produce them locally, we have petroleum products and everything that goes with it, iron and steel. You know, we have a lot of steel in Kabale and Chibale, tons and tons of steel. But we are importing steel because they're saying that the quality of steel we produce is not good. So we are doing all these dams, infrastructures, and roads with imported steel. So it's one of the biggest items we are importing, yet we actually have steel in Uganda. Veterinary drugs, all these farms that you see with very big expanses of cattle, pigs, what you name it, we have to import all the drugs. We do not have the facilities to produce all these drugs. Cereals, imagine we actually import a lot of cereal in Uganda, yet we have the northern part of Uganda with a lot of free land where we can actually develop the value chains on cereal and grain. Plastics, vegetable oils, and why we are in a crisis, because we had to produce import cod palm oil from Indonesia and Malaysia. Yet, by the way, we actually have a very big farm in Kalangala, which is not necessarily producing yet, but also in Congo. When we went to Congo, we discovered they have a lot of cod palm oil, which we could have been getting next door, but we had preferred ignorantly to go and get it from Indonesia and Malaysia. So there's something good that comes out of every crisis. Then we also have textiles, sugar, salt, fertilizers. And for the services, we do a lot of transport, importation, construction, medical, and all these things. And you can see all the labor flight that is leaving the country. So for me, we have a lot of opportunity, but we need you as the financial services sector to zero in into a mechanism and a framework that is going to really work very closely and with the private sector so that it just fits very perfect onto the deliverable platforms. And as other government departments, we are more than happy to partner with you in delivering some of these things. So the first thing which I talked about where the actual financing gaps are, and I am asking also that we have another forum where we can give you the actual statistics on exactly those funding gaps line by line, so that people, you don't reinvent the wheel. The information already exists within the country. You don't have to sit down and start cracking your heads and start researching afresh. So these financing gaps can be fulfilled by you people sitting down and designing your, by the way, even the bonuses. Mr. Chiemba talked about your bonuses being tied to some of these deliverables, how each bank is doing on helping private sector industrialization, as well as import substitution, as well as export promotion. So maybe if that's a good idea, people might actually deliver on what is being measured. If you're not measuring it, it will not be managed. There will not be progress. So maybe it's food for thought for the banking industry as well. So there's a lot of little technologies, but also the investment on technology and delivery. So digital financial services report from the World Bank. And I'm glad there's someone here from the World Bank. Mr. Kasidie, thank you so much for coming. It alludes to the potential of digitalization of services powered by fintechs to lower the costs of economies and increase scale, because scale is also a very big problem. 2 months ago, someone placed an order from Uganda to just send beans for 6 months. There were people so excited, I put them in touch with the markets in Dubai, and they only supplied beans for 3 months. The rest of the 3 months, they could not supply. Why? We are not organized in a way that we can supply. I'm glad that you're also talking about the export fund. And also, if the fund is very expensive, people will not access it. The bureaucracies on the applications for funding is also a problem. Please, the paperwork that needs to be done for these small people, it's already intimidating for them to walk into a bank branch. And by the time they put themselves together to start producing for you, it is already very difficult for them. So the paperwork, please, just compress everything and maybe give them the services on their phones, give them the services in one stroke of an application so that they can access these services to buy inputs, to facilitate the value chain in a meaningful way so that they are not bogged down in paperwork. So that transparency, the speed and ease of transaction security and transparency was very poor, according to that report. And they urged the adoption of initiatives that could amplify post-COVID-19 transaction out of our financial services. There was also something which I want to bring to your attention, really, which is the Universal Financial Access, UFA 2020 goal. This was produced and it was aimed at ensuring that adults globally have access to a transaction account or electronic instrument to store money, send and receive payments as a step forward towards broader financial inclusion. But Uganda banks, therefore, must also acquire the same goal so that they are in tandem with this universal financial access. So that people can find it easy to access your financial services to facilitate trade and production and industrialization. So we need to promote trade, improve productivity and quality of life. So there is need for banks to undertake comprehensive research diagnostics, credit risk review with the aim of having a wide presence in the MSMEs, because you are the people who are going to graduate these MSMEs from where they are into middle, into the bigger people that you see. And I'm glad that Mr. Chiemba also talked about it. So climate smart projects, because we are talking renewable energy and sustainable manufacturing. It's very important. Everybody who's going on the agro-industry and all value chains, they must actually do responsible lending, sustainable manufacturing development and support. So I would like to inform you that the government through our ministry is currently doing a study to establish a cooperative bank. Why we wanted to do the cooperative bank is because we realized that the product range on the market is insufficient to service the very last person who would like to join cooperatives and produce collectively in scale. So please do not hit us or compete with us or chase us. We need your support. But as we said, we are going to be partnering with private sector to deliver some of these things. So everybody has a niche in the market, and the market is just beginning to grow because there are more and more members joining the East African community. We have COMESA, we have the African Free Continental Trade Area. So, and sometimes, I mean, people call from Egypt, they want milk. And there's no trade facility to even help them on milk. So we just need to come together and use this information on trade, industry, and cooperatives in a way that everybody benefits. So there will be no fights, but we just need support to do that for the last guy. So ladies and gentlemen, I'm not going to go into the details of the East African exports because we know, as you talked about DRC, just know that we are launching the Mpondo Border Export Zone, OSBP, the one-stop border post. And by the way, we need some banks in there because there's a lot of foreign exchange needed and financial services needed on some of these border posts. There's the only border post actually in Mpondo is the one with a cold room. So you can even export all your fresh dairy and fruits and vegetables. 2 very big rooms and they're all free. And people who are on the value chain of production don't know about this, but I'm sure we're going to do some publicity for them to know. So even Goma and Gwoli, they're all upcoming. The growing market and opportunities we shall also be putting on our websites, but as well as continuing to share the information where banks would like to position themselves and gain out of all this trade. So the choice is going to be yours to embrace and take on these opportunities. So I call upon all these bankers today, stakeholders, and all the people producing and all our development partners, government including all the strategically included stakeholders together to help transform our country into proper middle income status. So I sincerely hope that this conference and discussions will yield the results that we need. I look forward to hearing from you, this fraternity, the feedback. We see the reports and we see how we can actually partner together. And many of you have been contacting me to get the parish development model SACCOs because you want the SACCO money, you want cheap deposits. You're welcome. And there's a lot. I mean, it's 11,594 parishes. Everybody wants a piece of that, but I think we can do more than just waiting for these SACCOs to register. And I mean, bankers, you're bigger than that. You're deeper than that, registrations and getting deposits. So please demonstrate to us that you can actually go deeper into our value chains of production and manufacturing. So we shall take away these resolutions, we shall wait for them, and then we'll see what happens next year and how far we have gone. With all this, I do not want to bog you down any further, and I wish you very good deliberations. If anybody has any questions, I operate open door policy, and I wish to stop here and wish you all the best in the next 2 days for God and my country.
Wonderful. Thank you so much. Permanent Secretary in the Ministry of Trade, Industry and Cooperatives. I try to repeat that. Thank you so much, Geraldine Sally. Never one to mince her words. And I've seen a lot of pen to paper as she spoke, which is a good thing. So here goes. We'll have discussions, which means there'll be As you've seen the setup, there'll be panels. There'll also be a keynote address. So if there's any question or a comment, it might not be easy for you to remember it as the conversations go on. Note it down. We've put, I think, specific books and pens wherever you are. That way we'll be having a Q&A session that is broken down into 2 sessions. So keep the thought. If you think it might go away, write it down. Please, by the way, just to recognize, because part of our theme is including agribusiness sectors, and our powerful sponsor is ABI, or the Agribusiness Initiative. ABI, are you here? Where's the team? Oh, there you are. Thank you so much. And I was actually told that at the start of the Bankers Conference, there's a specific sponsor that has stayed from the beginning till today. Does anybody know that sponsor? Who's that? Ah, I hear the whispers. MasterCard, right? A round of applause, because 2017 till today, they've been title sponsors. So please welcome the country manager for East Africa, Mr. Sharia Ali, to give us a few remarks. Please welcome. This deserves a round of applause. Thank you.
Good morning, everyone. My name is Sharia Ali. I'm the country manager or area country manager for MasterCard covering East Africa. So that's 15 countries from Sudan all the way down to the Eastern Seaboard and the Indian Ocean Islands. I'd like to start by thanking the Uganda Bankers Association for the warm reception and your support and partnership. I'd like to specially acknowledge Honorable Dr. Wilbert Awar, Chairperson UBA, Ms. Sarah Rapta, Permanent Secretary, Ministry of Trade, Industry and Cooperatives, Ms. Geraldine Sali. We just heard from a very impassionate plea and address from her, and I really felt it. I'd like to also thank Uganda Manufacturing Association Chairman, Mr. Tio Kayamba, and Bank of Uganda Deputy Governor, Mr. Michael Etingego, and the esteemed guests and leadership present in this hall today. Before we dive into the agenda for today, I'd like to share a misconception around MasterCard. So our name kind of creates this illusion, or maybe a rightful one, that we're a cards company. Well, just like Apple is not selling fruits and Amazon is not a shop on the river in South America, MasterCard is much more than just cards. We started out as a cards company for sure, back in the day, but the world has changed so fast that we had to pivot and we had to change our direction. So we are now a technology company. We operate on multiple rails, which are inclusive of accounts, cards, remittances, e-commerce, blockchain, and the list goes on. Our solutions are accepted at millions of MasterCard branded merchants and ATMs across 210 countries. And I'll share a little bit about what MasterCard intends on doing and how we're collaborating in the region. But let's first understand the problem. If you think about it, and when you see we, and at the topic of this conference where we're looking at manufacturing, agri-sector, and tourism, these are sectors that have been most hit by the VUCA world that we are living in. And volatility, uncertainty, ambiguity, and complexity is resulting in accelerated evolution. The question is, why are we accelerating and why are we evolving? And the answer lies in the fast-changing needs, priorities, and evolving consumer behaviors. So if you look at ourselves, let's say we're awake about 16, 17 hours in a day. Out of that time period, 4.5 hours, we are sitting in front of screens. Some of you are sitting in front of screens right now. Now, if you come out with a solution which does not cater to that form factor, chances are there's a high probability that your loss of relevance is guaranteed. And let me give you another example. How many people in the hall remember that beautiful relationship between a pencil and a cassette tape? I'm dating myself here. There you go. What a pleasure it was, yeah, when you had to like fix the all jingled, tape. Or, the amazing CD player or the Walkman. When I talk to my kids about it, there is no connection whatsoever. It just doesn't exist. They look at me, I'm like I'm a dinosaur. But, now we have these, online streaming platforms like Spotify, millions of songs available for, at your fingertips, no need to go anywhere, no need to bargain, nothing. Let's look at the textile and the health sector. So what did COVID do? As soon as COVID came into play, what did the textiles and the health sector and many other manufacturing industries, they had to pivot. It wasn't a pivot of their choice. It was something that came out of necessity, because we needed PPEs. We needed the personal protection equipment, right? We needed the vaccines. We needed the infrastructure for the distribution of those vaccines. So that tells you suddenly we showed our resilience as the human race, and we addressed the need that was there. If we bring our focus now to the Pearl of Africa, our fast-growing Ugandan economy at pre-COVID levels of 6% plus. I think right now we're run rating at about 3.5, 3.6. What challenges did we face? It is COVID, yes. It is the Ukraine-Russia war yielding inflationary pressures. Inadequate rainfall hurting. So our previous CEO, Mr. Ajay Banga, shared with us a nice geometric figure of a triangle and kind of explained it in a very simple way. And he said that, look, if you look at the triangle, on one side you have the challenge of the one versus the many. And by this he was referring to financial exclusion, where those who lack access to financial services due to their gender or socioeconomic background suffer the most or are left at the periphery of the society. On the other side, he showed us man versus nature. Guess what? The inadequate rainfalls, the rising temperatures in Europe, record temperatures that we are seeing these days, global warming as a whole. These are all factors that the environment is pointing towards us that we better think about our working environment and our businesses in a sustainable manner and hold ourselves accountable. At the base of all of this was a choice that all of us make day in, day out, or maybe around the planning season. So this is perfectly ripe because I think a lot of us will be going into our budgetary sessions, or maybe we're already in it. But the choice between deciding for the short term, where we have a value to deliver to our shareholders, versus long-termism, thinking about sustainability, thinking about what's the right thing to do today. How do we, for example, if you look at the MSMEs, how much pain have the MSMEs gone through during COVID? A lot of them have just been wiped out. And guess what? They were looking towards us, and were looking for us to help them and partner with them and be flexible with them. And I think that choice, it's becoming evidently clear. Short-termism just won't work. We need to have a balanced approach and ensure that in the long term, what we are doing will deliver value to not just us, our future generations, and our countries. So if we were to walk away with three principles that we could develop on during these 2 days, I would say partnerships are key, as we are much stronger together than individually. Public-private sector partnerships to shore up and strengthen manufacturing, agri-sector, and tourism is critical. Access to finance is vital, empowering the economies and business sectors. FIs, generally, or any underwriting organization can only do so if there's a digital footprint. Unfortunately, cash doesn't provide us that. And so we need to be enablers of digitalization in our ecosystems so that all that transactions and commerce is recorded, and it'll make your decision-making easier. And that's where MasterCard plays a pivotal role. Lastly, we must continue to invest in the tech infrastructure and the networking infrastructure in our part of the world to ensure financial inclusion in its spirit. So what is MasterCard up to? I'd like to just showcase a couple of examples amongst the many. The first one is the MasterCard Farm Pass, which we are proud to have launched in Uganda, working closely with Yo Uganda and Equity Bank, and I'm certain that we'll be rolling out with many of our other partners in the market. What does this program do? So it's basically a digital platform that connects smallholder farmers to credit, high-quality inputs, and market access. It gives them an improved access to buyers and increased price transparency, enabling many farmers to command fair prices. FarmPass now consists of 900,000 farmers already enrolled, and we do believe that at the current rate of about 40% growth year on year, the numbers are only bound for the north. In the tourism sector, we have recently gotten into a partnership with the Kenya Tourism Board, and we're already in talks in Uganda and Tanzania and a number of other countries, where we're entering into a 3-year collaboration comprehensive MOU and agreement. The goal of this MOU is to drive tourism numbers by leveraging MasterCard's various assets. One of them is the Priceless.com platform. You can visit it and see what it has to offer in terms of attracting global attention. We've got the Data Insights platform. We have the terminalizing of not just the national parks, but all tourist sites across the various countries so that foreign tourists can come in and not have to localize their payment form factor, but rather use the ones that they already have. We are further going to curate loyalty and rewards programs to boost tourism through partnerships with all of you, and of course, roll out campaigns. This will be replicated in Uganda in the short term, and we're looking forward to that. I also want to thank you for your time invested over these 2 days. And I reiterate MasterCard's commitment to Uganda, which will yield in increasing MasterCard's presence locally, including a locally registered entity, which gives me great pleasure and pride, and representation on the ground as well. Please enjoy, co-ideate, collaborate, and let's partner together to make an impact for our future generations and ourselves. Thank you very much.
Thank you so much, Mr. Sheria Ali, who is Country Director for MasterCard. And speaking of sponsors, we do have our partners who have some products and information for you. Once you walk outside, there is a big tent, which is our exhibition booth tent. The exhibition is going on throughout the day, today and tomorrow. So if you catch a breath, you might want to go there and see. Not break yet, though. Allow me to welcome back Ms. Sarah Rapta, who's our chairperson, to invite who should be our guest of honor today to give us a few words from our co-host and really a guest, but also co-host, really, Bank of Uganda. Please, Sarah.
Thank you, Flavia. It's my distinct honor and pleasure to invite our Deputy Governor, Dr. Michael Ego Atingi.
Thank you, Sarah. all protocol, as earlier mentioned, is observed. A very good morning to you, ladies and gentlemen. Before I delve into my remarks, I want to beg your indulgence to take a moment to remember our departed gallant governor, the late Professor Emmanuel Tumusiime Mutebile, who died in January 2022, and for where I'm humbled to speak to you today in a place where he previously spoke, and also to spare a thought for the lives lost during the catastrophic COVID-19 pandemic that struck the world in a crisis like none other. Just a moment, please. Thank you. Ladies and gentlemen, it's an immense privilege to address the 5th Annual Bankers Conference, and I'm most pleased that Professor Benedict Oramah, President of the Afrexim Bank, will address us through his trusted delegate, Dr. Fofak, who's going to be our keynote speaker. The theme, Bridging Financing Gaps in the Manufacturing, Tourism, and Agribusiness Sector for Economic Recovery and Growth post-2021, is an aptly chosen theme for this year's conference. Allow me to quote from the book of Ezekiel, chapter 22, verse 30, where it says, the prophet said on behalf of God, quote, I searched for a man among them who would build up the wall and stand in the gap before me for the land, that I would not destroy it, but found no one. For emphasis, not even one. We'll get back to that later. The COVID-19 pandemic, the geopolitical conflict, climate change, have breached the safeguards for lives and livelihoods with unfamiliar havoc. The Russia-Ukraine war sucked the momentum out of economic recovery following the ending of the lockdowns and social distancing measures to contain the spread of the pandemic. Shortages of essential commodities have spiked inflation, resulting in tighter monetary conditions worldwide. In addition, and in the case of Uganda, drought has added pressures to the strained supplies of agricultural produce, thereby hiking the risk of hunger and stoking inflation further. Moreover, protectionism abroad has forced prioritization of domestic industrial capacity. But uncertainty about economic growth expectations due to several shocks hitting the economy has made banks shy in advancing credit to the private sector for fear of potential defaults due to poor business prospects. The financing gaps will constrain the rejuvenation and enhancement of local industrial capacity to cover the supply shortages bedeviling the economy. It is a testament to an active social consciousness that the banking fraternity is examining its duty and capacity to seize the moment and step into the breach caused by the crisis ravaging the lives and the livelihoods today. In examining whether financial institutions are up to the task and responsibility of supporting industrial recovery for high economic growth, this conference demonstrates that the banking sector seeks ways of stepping into the breach. We are pleased to see that the banking sector is responding to the call by His Excellency the President, Yoweri Kaguta Museveni, for the financial industry to actively support the community in which they operate on top of making profits for their shareholders. Recall His Excellency the President recently asserted that, quote, the financial sector is key to sustainable economic development through mobilization and use of domestic savings and investments. But, unfortunately, the sector is not reaching its full impact and is far away from playing its due role in bringing prosperity to all Ugandans. This conference shows that the banking sector is ready to meet the challenge posed by the President. by exploring their role in propping up and powering Uganda forward, particularly the industrial capacity, especially in manufacturing, tourism, hospitality, and agri-business. Ladies and gentlemen, please read the conference magazine that has been distributed to you, paying particular attention to the forward of the chairperson, Uganda Bankers Association, the permanent secretary, Ministry of Trade, Industry and Cooperatives, and that of Ministry of Tourism, Wildlife and Antiquities. Their statements indicate the potential impact of manufacturing and tourism on economic recovery and the specific approaches the banking sector can undertake to unleash the sectors. So please take a moment to read it later on. We expect that by the end of this conference, it will be clear how the banking sector can play its role in unlocking the full potential of finance in catalyzing economic growth and prosperity for all Ugandans. The banking sector can play its envisaged role of spurring the economic recovery because it remains solid and resilient, having entered the pandemic with sufficient capital and liquidity buffers. The Bank of Uganda regulatory and supervisory framework, supplemented with interventions such as credit relief measures, restrictions of dividends and discretionary payments, and liquidity assistance, stilled the banking sector from the worst effects of the prevailing shocks. Consequently, banks hold strong liquidity buffers underpinned by growth in liquid assets, mainly government securities, of course, and deposits. The aggregate liquidity coverage ratio was about 185% in June 2022, above the minimum prudential requirement of 100%. So to date, banks hold sufficient capital. They meet all the capital adequacy requirements, capital conservation buffers, and the respective systemic risks, capital buffers requirements where required. Solvency stress tests showed that banks were resilient to potential shocks, including credit risk, at least in March 2022. In addition, increased profits boosted the capital and liquidity of banks. So, as banks take on the mantle of stepping into breach the restoration of credit growth to pre-pandemic levels and above, they must maintain fidelity to prudential standards, primarily because non-performing assets ratio has increased to 5.8% at least in March 2022, and the operating environment has remained challenging. The recent shilling exchange rate depreciation and inflation surge complicate the operating environment further. Therefore, we hope today and tomorrow's conference sessions will consider how bank financing can stimulate productivity growth and high-value exports to boost overall growth and forex inflows. We also urge the banking sector to finance enterprises and activities that preserve and protect the environment so as to manage the associated climate risks. Slanting financing towards industries without smokestacks, such as tourism, agribusiness, thus promote the environmental, social, and governance principles consistent with a sustainable financial sector. It is therefore my hope that this conference will also address itself to the very topical matters that are related to environmental, social, and governance sustainability, and how these pillars can best be incorporated in financing investment decisions, more so in the manufacturing and hospitality sectors, which have been singled out for this conference. In hospitality sector, Uganda is referred to as the Pearl of Africa because of its beautiful sceneries, a diversity of wildlife, hospitable and friendly people with different cultures, and amazing climate all year round, notwithstanding this year, of course. This offers great opportunities for banks' involvement in a number of sustainable ventures that involve funding in the reduction of greenhouse emissions and improving resource efficiency in key tourism value chains such as foods and beverages, accommodation and meetings, conferences and events. For instance, banks could develop funding opportunities for ecotourism ventures. Similarly, there are several opportunities in the manufacturing where banks can play an immense role in promoting sustainable buildings and construction and circular value chains. For example, in the textiles and the plastic value chains to increase reuse and recycling rates. However, all this requires deliberate efforts to craft financing instruments that are specifically aimed at promoting ESG to affect the long-term sustainability in these and other value chains of institutions, and that also support the socioeconomic transformation of the communities in which the projects operate. Ultimately, it's going to take a multi-pronged and a multi-sectoral approach to sustain the recovery and achieve high economic growth at the transformative levels of 7% per annum and above the post-pandemic levels. The Bank of Uganda's most significant contributions to sustained economic recovery is fostering price stability and a sound financial sector. Therefore, within our mandate, the Bank of Uganda is prepared to do whatever it takes to restore inflation to low and stable levels in line with maintaining macroeconomic stability. In conducting monetary policy, we are guided by our judgment that the average core inflation should be 5% 2 to 3 years ahead. Inflation above 5% target retards economic growth by compromising long-term planning and hurting savings and investments. When inflation surged recently, driven by external factors and drought, the Bank of Uganda increased the central bank rate and augmented the monetary tightening by raising the cash reserve requirement for banks to 10%. The tight monetary stance will be maintained and enhanced to prevent price increases, which are now generalized across consumer goods and services, from becoming persistent and spiraling out of control. As I come to the end of my remarks, I want to thank the members of the Uganda Bankers Association for leveraging technology to maintain the delivery of financial services throughout the pandemic. Thanks also for delivering and matching the Government Small Business Recovery Fund, SBRF, to support small businesses hit by the pandemic. Amidst the ongoing challenges and uncertainty, the Bank of Uganda and government do appreciate the vital role played by the financial sector in maintaining stability, service delivery, and reassurance. We look forward to the amping up of the banking sector's role in supporting our recovery with new investments, lending, and innovations to keep the economy advancing. I'm optimistic that this conference will craft a fruitful way forward by answering the question, are financial institutions up to the task and responsibility of filling the financing gap in manufacturing, tourism, and agri-business? And of course, by heeding to the call of the PES, Permanent Secretary Trade, Industry and Cooperatives, and the candid point raised by the ED, Uganda Manufacturers Association, and also the thoughts of the country director, MasterCard, we are going to find a man who is going to build the wall, stand in the gap for the Lord, and we will do what is necessary to ensure that socioeconomic transformation is undertaken in this format. So let me end my remarks by thanking the Uganda Bankers Association for convening this conference on the vital theme, and the President of Afri-Exim Bank for delegating Dr. Fofak to deliver the key address. And I thank you all for listening to me, and God bless you.
The Deputy Governor, Dr. Michael Atingi Ego. Thank you so much. Ladies and gentlemen, it's time for us to have that conversation. Just to remind you that as the keynote address is being presented, for all your questions, concerns, comments, please jot them down. We'll be having a Q&A session right after. But allow me to now welcome Mr. Hippolyte Fofak, who's the Chief Economist and Director for Research and International Cooperation at Afreximbank, to deliver the keynote address with our theme in mind as a topic.
Good morning, everyone. I can barely hear you, actually. Good morning, everyone. And I would like to join the Deputy Governor in stressing how the protocol has been observed, and really thanks the Deputy Governor for really welcoming us to Uganda this time, and thank the Ugandan Banking Associations for associating us to this important event, and quite frankly for welcoming us, Afreximbank, within the Uganda Banking Associations earlier this year. And my president, Professor Benedict Oramah, the chairman of the bank, could not come. I think he was really looking forward to this event. Unfortunately, had to really stick to prior commitments, but he made sure that the bank is well represented in this event. So I am here with my colleague on the left table. I think we have at least 3 or 4 of us. Really to show that the bank, Afreximbank, is fully part of this important initiative. I think the theme of this year is actually quite an important and timely one, as the governor said so well in his opening remark, and we fully concur. And I just wanted to start by, how does this work? Very good. I wanted to start this presentation by taking us through a quote by no other than John Maynard Keynes. The difficulty lies not so much in developing new ideas as in escaping from the old ones. And as the governor said, the old ones have been the colonial development model of resource extractions, which has not really helped in terms of volatility, but also, as said earlier by the chair of manufacturing associations, the idea that there is a higher risk, that manufacturing is too risky. So you combine those two, those are the old ideas that we now have to overcome to create the conditions for sustainable growth and to set African country, Uganda in particular, on the path of fiscal and debt sustainability. I thought we should open by this important statement by John Maynard Keynes. And we will actually take you through, we have a comprehensive presentation, but I think we are going to emphasize the financing part of it, and which essentially it's important to stress that despite the tremendous potential for economic transformations, the contributions of manufacture and tourism to growth remain marginal within the African continent, and despite the fact that we have a very beautiful landscape, and we are the only part of the world where safari remains a possibility, I think it's something that we're not really fully exploited. And according to most recent estimates, I think manufacturing outputs account for just about 12% of GDP in Africa, against more than 20% in Asia, which, as you know, has become the world hub in terms of industry. Of course, there are significant differences across countries. I think if you look at Swaziland, for instance, it's almost at 27% of GDP against Uganda, which is essentially around 16%, not very bad, essentially above the continental average for that matter. And the story is somehow similar in the manufacturing sector, in the tourism industry, which has been one of the major sources of foreign exchange earning, especially in the least natural resource dependent economies. But despite its natural beauty, as I said, and the impact of hospitality industry within the continent remain quite marginal. I think if you look at the global figure, more than 1.7 trillion, I think Africa capture just about 2%, which is really not enough for such a large continent, which has a comparative advantage in natural scenery, as well as the fauna and so forth. But the Lilliputian nature scale of African manufacturing and hospitality industry has tremendous cost besides the fact that integrating the global economy, which is largely manufacturing, it's an issue. There are costs way beyond that aspect. And this is, if you just look at the global value chains alone, which before the pandemic were already at more than 50% of global trade. And if you add the non-global value chains, you can see that essentially you perform in the global environment only if you are in the manufacturing space. And going the commodity route will not take you very far. The global contribution of commodity is less than 15% of global trade. I think that's the way forward, essentially. But over the years, I think manufacturing has been a reliable vector of welfare improvement. Essentially, the path out of poverty has been through manufacturing. It's not just an issue of foreign exchange reserve, it also has implications for welfare, in fact, significant implications for welfare. And within the African continent, where unemployment rate have been at Great Depression level, over 30%, if you look at South African numbers, it tells us that this may well be the reason, the rationale for us to really invest in this sector beside the foreign exchange earnings. And I think the choice, as the governor said earlier, of the riding team is actually very timely, but also extremely relevant from the standpoint of development impact. Africa, which depends heavily on manufacturing import, was particularly vulnerable, found itself in a very vulnerable spot after the COVID-19 outbreak. We could not import, even those who could afford, could not import COVID-19 equipment, ventilators, vaccine nationalism. I think we found ourselves very vulnerable, calling for us to really boost our manufacturing capability to reduce our vulnerability to global volatility, also vaccine nationalism, also nationalism in general, what the governor called protectionism in his opening remark. Over the years, I think against this background, I think it is important to building back better. And building back better for the African continent may simply mean winning itself of that excessive dependency on import of manufactured goods and taking advantage of the AFCFTA, which entered into force last year, will be essentially an industrialization accelerator, especially as we fully implement the rules of origins, which is essentially a passport for industrializations. But financing is one of the key constraints on the path of that sustainable growth in manufacturing and hospitality sector, as said earlier by the previous speaker. And the key questions, which is posed by the Uganda Bankers Association this year, is, are African financial institutions doing enough to support these two strategic sectors? And what should be done to bridge the financing gap in this sector and set the conditions for structural transformations that we so much need. And then this takes us to really providing an overview of the state of manufacturing and hospitality within the continent. I'll be quite brief in this section. I'll essentially zoom through it. I think the right answer to the question, can manufacturing and hospitality catalyze growth post-COVID-19? The answer, quite frankly, is yes. And for several reasons. I think these are tremendous growth industries, and Africa has tremendous potential, which are still very much unexploited, whether it is in the tourism sector or in the manufacturing. And then we have another important aspect, not so much talked about, the favorable demographic trend within the continent. I think for all these reasons, it's very important to stress that, yes, it is the right thing to do, and they have tremendous potential to help achieve that goal. And for instance, if we take the tourism industries, in a sign of post-crisis normalizations, tourism-dependent economies achieve are set in current projections to achieve tremendous growth in 2022. And one example is Mauritius, which essentially went from 14% contractions in 2020 to about 6-7% growth rate forecast for 2022, pointing to a resumptions in the tourism sector. As for the manufacturing sector, which has sustained country on a robust long-run growth trajectory, the East Asian miracle, which reshaped the contour of the global economy, was essentially a manufacturing miracle, an export-led growth model. And that manufacturing revolutions, which positioned Asia, as I said earlier, as a manufacturing hub, the factory of the world, has actually also prepared the continent, the Asian continent, to capitalize on global value chains, export-led growth model, to become a powerful force. And the contrast between South Korea, for instance, and Uganda is illustrative. But we can also look at the contrast between, let's say, Vietnam and Mozambique, as we will see earlier and later in the presentations. But manufacturing is also the dividing line between developed and developing countries, between rich and poor nations. And across advanced economies, output manufacturing as a share of GDP is actually very high, in the 20-25%, whether you're in China, Korea, but also Germany, the leading country in that regard. Besides providing the path to an effective integration into global economies, manufacturing, which accelerate the process of structural transformations and foster inclusive growth, has been the most efficient vector of poverty reductions, as the contrast between Vietnam and Mozambique actually shows. Even though the two countries achieve robust growth rates above 5% for a long period of time, reductions in poverty was actually more significant in Vietnam's, in part because Vietnam has been more labor-intensive, export-led growth model than Mozambique, which rely heavily on commodities, essentially on capital-intensive, essentially export. The shared population classified as poor in Vietnam, for instance, fell to 13%, while in Mozambique, over the same period, approximately, was around 55%. Essentially, most empirical studies actually support the positive correlation between manufacturing output growth and economic growth. But not only is the share of manufacturing in GDP positively correlated to economic growth, but the negative related to poverty also suggests that the impact of manufacturing for low-income countries on poverty score is actually more pronounced and significant than what one would think. Now, to close on this section, I think it's important to also look at the theoretical foundations. I think in addition to supportive empirical evidence on the importance of manufacturing for development, I think the theoretical foundation is also very strong. And for instance, manufacturing offer special opportunity for capital accumulations. And we look at the US case where we have most recent data, which estimate that manufacturing drive almost 20% of capital investment in the USA. In other words, through manufacturing, we can actually change the landscape of investment across the country, moving away from essentially the vulture economy where they come and get the resources to inject the patient capital that's more sustained over time. The manufacturing sector also offers special opportunity for economies of scale and productivity growth. The US example, again, shows that it accounts for almost 35% of productivity growth. In other words, exactly what we need to become globally competitive. And finally, I think manufacturing sector offers special opportunity for technology transfer, which is what Africa needs most. The governor talked about climate change, but the success on climate change is on the technology, the right technology. Otherwise, we are going to be the lagging vector again in the global context. The manufacturing sector enhances the linkage and spillover effect, and to create the positive externality to investment in any given sector or subsector. So I think it's quite clear to us that this is really the directions to go. And banks and financial institutions, you'll be surprised, bankers, which invested heavily in the manufacturing sector in Asia, have actually been surfing on a robust long-run growth trajectory over the past decade, which has seen the balance sheet exploding. Suppose you were a banker, wouldn't you be investing in Sony or Mitsubishi? Wouldn't you? Say that I'm the one who financed research and development in Mitsubishi for this sea-moving boat and so forth. I think to be part of those actually create the conditions for joint growth, both at the corporate but also at the banking and financial institution level. But the benefit of manufacturing extends beyond commercial banks and corporate in an economic setting. I think manufacturing is macroeconomic stabilizing, Mr. Governor. And by sustainably growing foreign exchange reserve earnings and mitigating the exposure to recurrent adverse commodity price cycle, they provide the financial wherewithal, the chessboard that central bankers need to effectively manage their economies. So it's actually a win-win for everybody, the corporate, the bankers, but also the central bankers. Now, bridging financing gap manufacturing and hospitality sector, are we doing the right thing or are we doing enough? And quite frankly, and I said earlier by manufacturer associations, they are at the heart of the process of structural transformations. And the current deficit of the continent in the global manufacturing space arena is a clear indication that perhaps we are not doing nearly enough to address their concern and to grow that sector. And none of these constraints perhaps is as important as financing. There are several other constraints, infrastructure and so forth, but infrastructure somehow also relate to financing. As we know, infrastructure financing gap across the continent largely exceed $200 billion per annum. So financing is somehow at the heart of some of these constraints. If you look at just the SME space, the SDG space, I think the financing gap across the continent are huge, and $420 billion per annum just in the SME space. And if you zoom into Uganda, we are talking about almost $9 billion annually, just the financing gap for SMEs This is significant. It's a major constraint. So even before the outbreak of COVID-19 crisis, which like other economic crises, amplify the risk of pro-cyclicality of bank lending, I think they are refractory to risk. But even before that, financing was already a major challenge in the sector if you go by the size of the financing gap. Across the regions, these growth industries, which are key to reducing the credit rating negative correlations, rating agencies, between growth and commodity price cycle, have been considered too risky, as mentioned earlier. But data from the Central Bank of Uganda show that lending to manufacturing industries has remained very low. If you just look at 1 month in particular, I think it was about 2% of total lending in the lead up to the crisis. I think this compares unfavorably to countries such as Egypt, which have invested heavily in manufacturing, where the lending toward that sector is around 30%. But the ratios are even higher in Asia, where manufacturing has been the major drivers of growth. If you look at I mentioned Asia, but I can also mention Germany. If you look at the portfolio of German banks, I think they invest heavily in manufacturing. But most recent for the Central Bank of Uganda do not point to a drastic shift toward a significant increase in lending toward this strategic sector post-COVID-19. But the challenge of bridging financing gap in this key sector, quite frankly, is not specific to Uganda. It's a continental problem. In Nigeria, for instance, it is very important, the largest economy on the continent, the Central Bank of Nigeria, CBN, had to adopt a policy setting a loan-to-deposit ratio minimum threshold at 65% to boost lending to the private sector in December 2019. And with view to actually addressing and curbing the rather unfettered appetite toward government securities, which are essentially, as mentioned earlier, risk-free propositions. Before the CBN policy, and loan deposit ratio in Nigeria was about 57%, and compare that to 91% in South Africa or 76% in Kenya next door. And I look at the data from the Central Bank of Uganda, they were around 50%, 51% for commercial banks in Uganda. I think a review of CBN last year showed that the impact of the loan deposit ratio policy was both significant and, quite frankly and remarkably, almost immediate. I think at the height of the COVID-19, between January 2020 and January 2022, I think lending in Nigeria to private sector increased dramatically by almost 40%. It's quite remarkable. But what is also remarkable is that dramatic growth during crisis, when pro-cyclicality should be advising otherwise, did not lead to an increase in NPL ratios. In fact, first lending was more directed toward, if you look at this graph, the next graph, toward manufacturing, which beside oil and gas, which have dominated lending, manufacturing suddenly has become almost on par with gas industry. In other words, through the financial sector, Nigeria may be engineering its way out of the long, dreadful Dutch disease. In other words, more than fostering counter-cyclical financing by banks, the loan deposit ratio policy is creating the conditions to build back better post-COVID, expanding manufacturing capacity to reduce vulnerability to global supply chains. At the same time, I should say, the sharp increase in bank lending, private sector, did not lead to a deterioration of the balance sheet, as the review of CBN shows. Across the Nigerian banking sector, average NPL ratio declined to 4.8%, the lowest in years. In other words, the growth of this critical sector is perhaps wrongly affected by the excessive risk premium, which is reflected in the prohibitively high interest rate, including in Nigeria as we speak. I think across Nigeria, the average interest rate on loan to manufacturing sector was actually, in SMEs, actually very high, around 15.5%. So they still have a long way to go. Of course, it has to be related to inflation for that matter. And across Uganda, the lending rate is also just as high if you look at the latest figure we receive. I think this prohibitively high interest rate have set unrealistically high expected return on investment, and in the process, in our view, undermine growth and economic transformation to strengthen the foundations of the highly extroverted colonial model of resource extractions, which we said has a lot of risk in terms of setting country on the path of fiscal and debt sustainability. In Nigeria, the CBN is aggressively pursuing the dual mandate of price stability, but also achieving long-run growth through structural transformations. I think they're leading the charge of actually exiting those risks. In this context, they've actually entrenched financial repressions, interest rates, but also the perceptions. They are partnering with the Exim Bank, development banking, to actually provide direct financing to the manufacturing sector, but also diversify the source of growth. We can mention what they did during COVID, but also the manufacturing funds of almost 1 trillion naira is actually providing support to that sector. While the activist stance of Central Bank of Nigeria is yielding results, in our view, Mr. Governor, changing the institutional culture of financing and deployment of resources which prioritize risk-free government security and large multinational company is perhaps key to growth, to engineering sustainable growth in the manufacturing and hospitality sector. And available empirical evidence shows that unlike OECD countries, banks in developing countries primarily target large enterprise representing just about 1% of total firm. I think that's the data, that triangle that we mentioned earlier. You can see that large concentrations bottom where most SMEs in manufacturing had to rely essentially on microcredits as a result of the reluctance of banks. This is a global picture, the state of the art in the developing world, non-OECD countries. By contrast, I think micro firms, which represent around 70% of total firms, get meal credit, and depending largely, as we said, on microfinance institutions. However, I think the growth of manufacturing industry and SMEs, which are critical for healthy recovery post-COVID-19, considering the potential of this sector for employment and integration into global economies, require both large and patient capital, both of which cannot readily be made available by microfinance institutions. And I think the development banks and finance institutions have played a major role in the rise of manufacturing. I think if you look at Germany, their development banks have been the major drivers of growth in Germany. If you look at the China development banks, a major drivers. I think it's so important that there was an article a couple of years ago, maybe 3 years ago, in India saying, bring back our development banks, which were essentially killed after, in the turn of the century, in 2010, and they've seen that as a result of those banks disappearing, there's been a major drop in actually industrialization in India. Now there's a call for the current government to bring back the Indian Development Bank, for that partnership between commercial banks and development banks, which enable them to spread the risk, but also reduce the risk that commercial banks potentially face. Now, I just want to take you through quickly to what Afreximbank is doing on its part to support this mandate, and then we close. I think, as I said, even before the outbreak of COVID-19, the bank had actually prioritized manufacturing, hospitality sector, which are, in our view, key to diversifying African export, but also the source of growth. I think these strategic sectors have been reflected in the bank's successive plan, Plan 5 and Plan 6 currently, and they emphasize essentially intra-African trade and AFCFTA implementation, the current plan, but also industrialization and export development. And so even before the pandemic, the bank has taken that stance. And interestingly, the two pillars, the first, intra-African trade and industrialization, are actually mutually reinforcing, in part because, as you know, manufacture dominate intra-African trade. So as you grow intra-African trade, you will actually carry along industrialization and manufacturing. It's a wonderful opportunity, the AFCFTA, for the rise of manufacturing industry across the continent. So to bridge financing gap under its successive plan, the bank has really supported the growth of this strategic sector through direct financing, but also through innovative financing mechanisms. For instance, the bank disbursed over 1.4 billion over the last 5 years toward manufacturing projects, which includes refinery, fertilizer, but also light manufacturing, agro-processing project, and manufacturing plant for beverages, but also tea. And we are set to essentially double that amount in the coming years. And already we have in the pipeline almost $3 billion project that we are under considerations. The bank direct support toward hospitality has been through its Contour program, which aimed to lay off construction risk to parties best able to manage them. Under the program, the banks has actually deployed 2 relay instruments to address financing need, but also promote tourism across the African continent. I think under the Contour program, we have contingent guarantee issued by the bank to constructions to provide assurance of take-out upon completions, and then the relay components, which aim as taking over the construction facility so that the burden is not really on the promoters. Under our Contour program, the bank has disbursed more than $200 million to support development of hotel across a number of countries, both in East, West, and Southern Africa. The bank will actually increase financing toward hospitality, and as we speak, the bank has a pipeline of projects worth almost $500 million, which cover countries across West, Central, but also East Africa. I think over the years, the bank has also drawn on innovative financing mechanisms to support the growth of manufacturing and hospitalities. I think these include its guarantee program, which helps support long-term financing, while at the same time lengthening loan tenors. Our successful ECA facilitation program is also very important and fascinating to help African institutions acquire essential goods and services, essentially the capital good that manufacturers so dearly need. And then our syndication program, which has enabled us to draw on our convening power to leverage more resources globally into the continent, achieving a leverage ratio of almost 1:8. And one example which gives you a flavor on our syndication, at the height of the pandemic, I think we worked with the Tanzanian government to actually leverage almost $1.3 billion into the Tanzanian economies and achieving a very impressive leverage ratio of 1:10. in that regard. I think through our syndication agency functions, the bank has been able to mobilize almost $12 billion in support of growth within its member countries. I think the African Development Finance Institution par excellence, the bank has also drawn on counter-cyclical support to provide timely financing to African entities, both sovereign and corporate, to essentially quicken the process of economic recovery. I think through its pandemic trade impact mitigation facility, the bank provided timely financing to its clients to help them deal with acute pressure on liquidity and sustain growth, and in the process, soften the impact of COVID-19 shocks, but also create the condition for faster and prosperity post-pandemic. And the bank has disbursed almost $8 billion as part of its pandemic response. In addition to providing timely response to assuage liquidity constraint and pressure, I think PATIMFA has enabled the bank to collaborate with private sector to accelerate diversification of source of growth and export. The support extended by the bank under PATIMFA has also enabled African entities to expand processing capacity for domestic productions. We are investing now in the pharmaceutical industry as a result of that effort. To conclude, Mr. Chairman, I think our African financial institutions doing enough to bridge financing gap in manufacturing hospitality across the continent to catalyze recovery post-2021. And our answer, Mr. Governor, is not nearly enough, especially considering the huge financing gap across the different sectors. And the turbocharged normalization of monetary policy by systemic important central bank, the Fed, the EU, the ECB, could actually add another challenge to what we are facing, a major constraint, at least in the short term. But still, I think overcoming, in our view, the institutional culture which assumed that this sector are too risky is perhaps the most important bounding constraint that we see, as the example of CBN, the Central Bank of Nigeria, clearly shows. The success of that experiment should incentivize both monetary authority and banker across the continent to allocate more resources toward this sector, as they are critical not only for recovery post-COVID, but also, and more importantly, for a successful implementation of the AFCFTA and effective integration into the global economies. Manufacturing and manufactured goods dominate both extra and intra-African trade and could put countries across the regions on a long-run path of fiscal and debt sustainability. Afreximbank is supporting the process of export diversification, working closely with its trade finance intermediaries and drawing on its convening power to leverage more resources into the continent. Again, and to quote John Maynard Keynes to close, the difficulty lies not so much in developing new ideas as in escaping from the old ones. I think together we can escape the colonial development model of resource extractions to become a powerful force in the global economies in the post-COVID era, dominated by the increasing quest for more resilient global supply chains and implementations of the AFCFTA. And on behalf of Professor Benedict Oramah, we would like to thank the Uganda Banker Associations and all its members for welcoming Afreximbank last month. Thank you very much.
I'll just check again. Is everyone okay? Do we need a break? Yes? Do we need a break? Oh, wow. Here I was about to put you into some deep conversations. What say you? 2 minutes? 5? 5 is safe, yeah? All right. So it's 11:04. In 5 minutes, we'll come back. Deal? All right. The 5 minutes start now.